Hi everyone, I'm Paul and welcome to my review of Lesson 20 of ICT's 2022 Mentorship Program. This video builds on the setups that we covered in Lesson 19, so if you haven't watched that video yet, I recommend that you watch that first because this video will make a little bit more sense to you. We're also going to introduce the London Killzone for the first time in the Mentorship Program, which is one of the trading windows that ICT uses in his methodologies. But before we jump into today's video, make sure you subscribe to my channel if you haven't already and turn on notifications so that you never miss an update. Lastly, if you enjoyed today's video, please give it a like. This helps other people to find it and is a quick, easy and free way for you to support my channel. So everyone's a winner. Now let's jump into today's video. So today's video is Lesson 20 of ICT's 2022 Mentorship Program. And our outline for today's video, firstly we're going to cover the London Killzone. So we're just going to do a brief introduction to that particular time frame. It's also known as the London Open. Then we're going to apply ICT's concepts to some trading examples, firstly on the Dixie or the DXY, and then on the Euro or the Euro US dollar. So firstly we'll talk about the London Killzone or the London Open. Now the London Killzone is a period from 2 a.m. and that's New York time to 5 a.m. New York time. And so the London Open or the London Killzone is another one of ICT's particular time zones or windows, if you like, to be executing trades. So we've been using the New York Killzone or the New York Open throughout the mentorship so far, but the London Killzone is a window that precedes the New York Open. And then you also have the Asian trading range or the Asian Killzone as well, which you can use as another trading window. So what I'll do with my charts is I'll mark up a box which outlines the London Open, so from 2 a.m. to 5 a.m. and obviously we have our charts set to New York time, and then I'll measure out midnight New York time out into that kill zone, which gives me where the midnight open is, or the first opening marker that we use in ICT's framework for that particular session. Now firstly, the London Open or the London Killzone is helpful because it's a particular time of day where ICT setups are at their most potent. But the other reason why the London Killzone is helpful is that often you'll get the high of the session or the low of the session painted in the London Killzone. Now this doesn't happen all the time, but it happens quite often. And this can be very helpful when you're trying to see if the power of 3 is in effect. And so obviously if you know that the low or the high has been painted in the London Open, then you can estimate or guesstimate what the rest of the session will be like, because remember you'll have your accumulation happening obviously then in the London Open, you'll have manipulation and then distribution running into the close. So it can be very helpful in predicting or confirming that the power of 3 is in effect, and then you can obviously use that to your advantage to plan trades around the rest of the session. So the first chart we're going to look at in today's video is the Dixie or the DXY, which is the US dollar currency index. Now you'll recall from lesson 19, this is pretty much the same market picture we were looking at before, but just with a little bit more price action. So this was the move that we were looking at. We had these relative equal highs, this buy side liquidity resting up here at 101, so at that institutional price level. You'll recall we then looked at the market selling off. We took out the sell side liquidity. We almost came back to that mid-level of this move that broke market structure over here. We've created this sell side liquidity here. The market then traded higher again. We took out these relative equal highs and then the market has sold off. Now the move we were looking at the time was this move here. So you can see this particular candle has taken out these other stops and that led to the sell-off, and we had this market retracement here, and the particular move we were looking at the time was this move from this low here up to taking out this buy side liquidity or creating these relative equal highs here. Now the following price action is pretty much exactly what ICT predicted would happen in that particular video. Now he marked out, I'm pretty sure it was either this level or it may have been this level down here that he was expecting the market to retrace towards before it then came back up and revisited these relative equal highs here. So that's exactly what happened, and you can see the market's traded down into that level. We've hit this bullish fair value gap down here. The market's immediately reacted to that and traded back up to these relative equal highs here. So this is something that I always look for in my trading now, is we have the source of liquidity here where smart money is going short, so they're triggering off all this buy side liquidity here. So the buy stops, you can see this candle pokes through and takes out all of those stops just there, creates that liquidity pool to sell into. The market then trades lower. You can see we break market structure here, we take out that sell side liquidity down here, and we trade into this new source of liquidity down here, which is where smart money is obviously getting out, potentially reversing their position to go long, and then we trade back up into these relative equal highs where there's again buy side liquidity residing, where they can sell to close out their positions if they were going long down here. Now, if we zoom into our 5-minute chart, we're on our 1-hour chart before, you can just see all of that price action in a lot more detail. So you'll notice here in the green box, we have our London Killzone. So that's from 2 a.m. New York time down to 5 a.m. New York time. And so we're obviously working on New York time. So I've got our trading screen set to the New York time zone. And this is that move from the relative equal highs. So you can see even more clearly here, that candle there is the one, and I'll just mark this out. This is the one here that took out those stops, which then led to this sell-off. You can see we came down and traded into this bullish fair value gap down here. So that purple line, I'm pretty sure, is the one that ICT noted in lesson 19 was the target that he was looking at the market to trade back into. You can see we do that. It's obviously quite precise. We trade down into that fair value gap, and then the market instantly reacts to that. So you can see in reaction to that, we get our fair value gaps. Again, this is on the 5-minute chart that gets formed just here after we take out, or we dive into that liquidity, I should say. You can see we have a small consolidation as that fair value gap is formed, and then the market moves away. So this is that displacement that ICT is talking about, and we want this strong run away from the fair value gap, which then breaks market structure. So this is exactly what we want to see. There's our little swing high just here, and you can see this is this move that is the displacement. So this whole move here, which breaks market structure, you can see the market then trades back into that fair value gap. There's a little bit of drawdown there before the market moves away, trades into it one more time, and you can see how strongly the market then reacts from that fair value gap. It trades right up into this imbalance here, eventually fills this in, we get a bit of consolidation again, market pulls back and then runs back into that midnight open before taking out the relative equal highs here at just over $100. So again, at one of those institutional levels. So this is often when I'm trading the London Open myself, that I'll do is I will be looking for a liquidity grab, my setup using a fair value gap, and then a run back into that midnight open for my exit. And this is a fairly reliable setup, and you obviously need to mark out your midnight open, and one of the key determinants is just how price reacts from that midnight open, taking out liquidity, and then, as I said, generally reversing back to that midnight open price. So before we go on to our next chart, which is the euro, just take note of this level down here. So this is the low, I guess you could call it, on the Dixie. So the Dixie takes this big pullback, we go into that fair value gap before it takes off. So just take note of this particular level, because when we look at the euro, that's going to be a key point of interest for us in the next part of the video. So the last chart we're going to look at in today's video is the euro, or the euro US dollar. So one of the things just to note when we're talking about the euro, and remember we talked about correlations in lesson 19, is that there's a negative correlation between the Dixie and between the euro. And you'll recall, just as we finished the section on the Dixie, I noted there was a section, the low, in the London session on the Dixie, and you can see we actually have, conversely, the high in the session for London for the euro. And so that's very indicative of that negative correlation, and you can obviously then use these instruments in concert with each other to help with setups and build confluence around, entries and confirmations and all that kind of thing. So that's a really important note. Now you're going to see this negative relationship between the dollar or the Dixie and risk assets whenever the denominator is in US dollars. So in this example, we're obviously talking about the euro US dollar, and you can just see here that we've got euros denominated in US dollars. So anytime you have the denominator as the US dollar, you're obviously going to have an inverse relationship or a negative correlation with the Dixie. So that's just something to keep in mind with risk assets, and one of the reasons why I'm always looking at the Dixie if you've seen any of my market updates. So getting back to the euro, you can see the price action. We've basically taken out these relative equal highs. We had this expansion higher going into London, and this is generally what we're looking at as part of our London setup. So we want to see a liquidity grab taking out either previous old highs or old lows where we know that there's going to be liquidity residing. And so in this instance, we've taken out the relative equal highs here, but we've actually gone back and taken out this high back here in a previous session from a previous day. You can see the markets run really hard into that particular level, and these are often some of the best setups because you get a full retracement of that move, and it's one of the key aspects of trading that London Open or the London Killzone. So if we zoom into our 5-minute chart now, we obviously can see more detail, more price action. And so this is that move up which took out the relative equal highs and then the buy side liquidity on the way up. And you can see we create this swing high just up here in the middle of the London Open or in the middle of the kill zone before the market pulls back, and then we trade back up. Now there's actually a fair value gap sitting here on a lower time frame. I've just marked it out on the 5-minute chart because my data doesn't go back that far, but I've got screen grabs of the 2-minute charts to go through that in a little bit more detail. But you can see the market reacts to that and then immediately sells off. So this is a screenshot of the 2-minute chart, just a zoom in of that area that I was talking about on the 5-minute chart. So this is that run into the liquidity we were talking about. We have the market move lower, and you can see in the process of moving lower, we have a fair value gap which is formed just there. So this is that pink box just here. I'll just highlight that. So that's our fair value gap. You can see the market then accelerates away from that fair value gap, and we break market structure on this orange sort of yellow line here. The market sort of trades up a little bit higher but pulls back even further. So this is that displacement that we're talking about. As the market runs away from that liquidity, it's created that fair value gap, so we run away from that. The market then trades back into it. So you see we get a little bit of drawdown as the market comes back up. We have a swing high here, and then the market trades away back down towards target. Now if we're looking at entering this particular trade on the 2-minute time frame, how we'd structure that is we would have our limit order at the high of the third candle. So remember our fair value gaps, this is a bearish fair value gap. We have a 3-candle formation, so there's 1 here, 2 here, and 3 here, and the fair value gap is formed between the low of that first candle just here and the high of the third candle just here. So we would place our limit order to sell at the high of that third candle, and then we would have our stop at either the first candle, so you could have it here, or you could have it at the swing high. So that's a personal preference and a risk tolerance decision. It's obviously going to affect your risk return profile. This is obviously the more conservative, and it just really comes down to how you've tested this setup and what you're most comfortable with. But you can see as the market trades back up into this zone, we'd obviously get filled on this up close candle just here. We'd trade a little bit higher. There's obviously drawdown at this point, and then we get the reaction that we're looking for as the market then trades lower. So we'll just head back to our 5-minute chart now and plot out how that return would have worked for us. So back on our 5-minute chart now, this is how that trade would have been set up. So we would have had our entry here. This is obviously 5 minutes, so I can't exactly outline the high of that third candle, but it would have been approximately just here where I've got the fair value gap boxed out here, and we would have had our stop at the swing high, say up here. So you'll recall from a lot of ICT's teachings, we talk about the move that breaks market structure. So if we run our fib from this point to this point, we get our 50% level. Now obviously we want to be shorting in a premium market, which we are in this case because we have our short position above this 50% level. It's right up here in this top quadrant of that premium market, which is exactly where we want to be. And so we'd be expecting the market to retrace back to that 50% level. And you can see if we'd taken that as our first take profit, or even if we wanted to exit in its entirety at that particular level, that would have given us about a 2.9 return. So that's a great trade. Now the other way you could have played that is to potentially take a partial there, or as I mentioned before in the video, you can be trying to trade to the other end of the range, which would be back towards the midnight open. So you can see you would have had to have held through the London Killzone into the New York Open and into pretty much the end of the session. You can see we don't hit that level until, quite considerably later into the session, but that would have been a fantastic return. You can see that's about a 6.5 return. The other thing you could have done is traded down into this fair value gap down here. You can see the market neatly trades back into that. Doesn't quite take out the midnight open at this point. It retraces before going back into that. But that would have been another good place to potentially take the rest of the trade off the table, or if you're taking partials here, take the rest down here. And that just feeds back into that concept about how we structure our trades in terms of we enter where the liquidity is being created, and then we exit where the liquidity is being created. So in this case, we'd be entering up here where the buy side liquidity was taken out. So that's going to give us that liquidity pool of buyers that we can sell into. And then as the market trails off, we're going to then close out our position down here in this other liquidity zone, or this bullish fair value gap just down here. And so how you take profits from these particular setups again comes down to your personal preference and how you've tested these setups in your back testing. As I mentioned before, there's easy ways to do this. You could take the whole trade off at this 50% level, or you could take a partial here and then allow the rest to run for these better risk reward targets lower down here. Thanks for watching my review of lesson 20 of ICT's 2022 YouTube mentorship program. I hope you found today's video helpful. If you did, it would be great if you could like it, because that helps other people to find it. And if you enjoyed this video and you'd like to see more content like this, make sure you subscribe to my channel and turn on notifications so that you never miss an update. Thanks for watching, and I hope to see you in the next video.